Very good evening to all of you. Come on, guys, tell me, is the audio and video clear to all of you? Is the audio and video clear to all? Come on, guys, please tell me. Can you listen me properly? Wonderful, wonderful, amazing, guys. Just a minute. Just a minute, guys. Yeah. Okay. And all of you, I request all of you hit the like button right now. If you're watching this session, hit the like button right now. Okay. Now, come on, guys. Let me start our session. Okay. So in the last class, okay, so far I'll just give you a recap of what exactly we have studied so far, okay. So for in the first lecture, we discussed about the orientation of ACCA, SBR. Basically, we discussed each and everything, what exactly is SBR, the paper pattern, the syllabus and everything, okay. Now in the second lecture, we discussed the basics of SBR, okay. Basically, what are the components of financial statements, what are financial statements, what are the elements of financial statements, okay. That is assets, liabilities, income, expense, equity, all those things. What are the basic rules of concepts of, you can say, P&L, other comprehensive income, retained earnings, basic rules of journal entry for that matter. Again, we also studied the concept of time value of money. Is that what we studied in the second lecture? Third lecture, that is yesterday, we actually started studying our SPR, and we studied prima facie about property, plant and equipment, where we studied first of all about the meaning of property, plant and equipment. So what I will do is, okay, what I will do is at the start of every class, I will help you recap the previous class. Okay. So now in the previous class, we studied prima facie meaning of property, plant, equipment, the recognition principle and the measurement principle. Okay, let's quickly recap it. Come on, guys, can you tell me what is the meaning of property, plant and equipment? So property, plant and equipment are tangible items. They are tangible items held for either production of goods or services, or administrative purposes, or rental to others. But keep in mind, whenever you give anything on rental, okay, it is property, plant, equipment. But if you give property on rental, that is investment property. If you give property on rental, that is investment property. And when I say property, I mean land, building or both. So if a property is given on rental, that is classified as investment property. Okay, now then so first was property, plant and equipment are tangible assets held for either production of goods or services, then administrative purposes, and third is rental to others. It can be any of these three purposes, okay, and the life should be more than one period. Now you must ask me, sir, how is it different from investment property? So investment property, point number one, includes only property. Okay, can a laptop be classified as investment property? No, it cannot be. Investment property includes only land, building or both. But does that mean that all the property will be classified as investment property? No. A property which is held for rental or capital appreciation or both is classified as investment property. But now that means if there is any property which is held for, you can say, administrative purpose, it will still be classified as property, plant, equipment. A property which is held for production of goods or services, it will still be classified as property, plant and equipment. Okay, that briefly summarizes the meaning of property, plant, equipment and investment property. Now moving on to the next topic, that is recognition principle. What is the meaning of recognition principle? Now if an item of asset, if an item qualifies to be a property, plant and equipment, okay, let's suppose this calculator is a property, plant and equipment. Now comes the question whether we will recognize it in the financial statements or not. Okay, so now there are two conditions. One, economic benefits should flow to the entity, and cost can be measured reliably. Cost can be measured reliably. If both the conditions are satisfied, then in that case we say that the property, plant and equipment will be recognized as an asset if both the conditions are satisfied. Then we say that the property, plant and equipment will be recognized as an asset and we depreciate it. If either of the conditions are not satisfied, then whatever cost we have incurred will be expensed off to P and L. This is the recognition principle. Now comes the next part, that is measurement principle. So under measurement principle, we discussed yesterday that initially an asset is recognized at cost. Initially an asset is recognized at cost, and subsequently we can measure it either under cost model or under revaluation model, either at cost model or at revaluation model, either of these, either at cost or at revaluation. Okay, it can be either of these two models. Now comes the first question, what is the meaning of cost? So cost includes purchase price minus trade discounts or rebates. If you have received any cash discount, that will go to P&L, plus non-refundable taxes minus refundable taxes, plus any directly attributable costs incurred to bring the asset to the intended location or condition. Now comes the question, what are the inclusions or exclusions of these directly attributable costs? So that also we studied yesterday, the inclusions or exclusions. So these are the costs which are included, these are the costs which are excluded. So this is what we studied yesterday. I believe everything is clear to you guys so far. Come on guys, can you please give me a heads up if everything is clear, or if you have any query, first of all discuss that query with me and then I'll proceed further in the today's lecture. We just spent I think around 5 minutes, but these 5 minutes I believe are quite very much valuable. Why? Because in these 5 minutes you are quickly revising the previous class. And guys, I will always say it is your responsibility, always it is your responsibility that before coming to a lecture you must revise the previous lecture. Though I will do that, though I will be doing that in my lectures, but it should be your responsibility as well to revise the previous class. Will you do that from the next class? Come on guys, tell me. Come on, deal. Don't forget the deals which you are making with me. Okay, I am making a note of each and every deal that you have made. First deal was you will make the sessions interactive. Second deal was you will study properly and appear mock tests on time. Whenever we conduct mock tests, you will be appearing those mock tests. Third deal which you are signing today is you will revise every lecture before coming to the next lecture. Okay, I am making a note of all the deals which you are doing with me. Okay, so now today's lecture will start with the dismantling costs. So let us start. Dismantling costs. Decommissioning. It is also called as removal. It is also called as restoration costs. Now understand. Chalo, come on guys, tell me, what do you want? You want me to take up a theoretical example, or you want me to give you a real life example? What do you want? You guys tell me, what do you want? What do you want? A real life example or a theoretical example? Whatever you will say, I will do it. I will simply follow whatever you guys say. Real life example, chalo theek hai. Since you guys are insisting me so much, I will take up a real life example. Do you guys know what is this? Do you guys know what is this? It is called as oil rig. We call it is as oil rigs. Okay. Now, what is the purpose of these oil rigs? What is the purpose? The purpose of this oil rig is to extract oil from sea bed. Okay. Now, why do you think as of today Iran has that level of supremacy? Come on guys, tell me. Even I believe considering the situation today, I can say even Iran stands at a stronger position than US also, right? Because Iran has oil reserves. Right? Now, that's why Iran is standing so strong today also. Now, and this is the machine. Oil rig. This oil rig is the machine which enables or which extracts the oil from sea bed. Okay, so now understand how things work. Now let me explain. Let's suppose now here Iran wanted to extract oil from the seabed. Okay, or let's not Iran. Let's suppose US wanted to extract oil from seabed. Okay. Okay, chalo, theek hai. You guys tell me, you want examples pertaining to from an Indian scenario or from a global scenario? What do you want? Tell me, guys. I am like fully for you guys. Whatever you say, I will follow that. From an Indian scenario, let me take it from Indian scenario. Okay. The meaning will be the same, but just that I'll change the names. That's all. Okay, I'm taking the example from an Indian scenario. Okay, chalo. Now, so basically, tell me a name of a company in India which extracts oil. Okay, so from an Indian scenario, you can say Reliance, like Reliance Petroleum. Okay, now Reliance Petroleum extracts oil from the sea bed. Okay, now so what happens? Please try to understand. Reliance Petroleum has to. So what happens? Let's suppose this is the Indian territory. This is the map of India. I am very bad at the drawing, so if I make any mistake, please excuse me for that. Okay. So let's suppose this is the Indian territory. I am very bad at making drawings. Okay. Now, so let's suppose this is the Indian territory. Now, you know what? The waters besides the Indian territory, the ocean, not here, the ocean here, they are Indian territorial waters. Okay, now what happens? Let's suppose if Reliance has to install an oil rig here, if Reliance has to install an oil rig here, tell me, can Reliance do it? Come on guys, tell me. If Reliance wants to install an oil rig here, can Reliance do that? No. Reliance has to take a permission from Modi ji. Reliance will be required to take permission from Modi ji. Okay. So Reliance, what will Reliance do? Reliance will call from Mumbai to Delhi to meet Modi ji. Mukesh Ambani went to Delhi to meet Modi ji. Okay. And now the conversation. Listen to the conversation between Modi ji and Ambani ji. Okay, Modi ji and Ambani. Okay, Mukesh Ambani. Let us listen to the conversation. So this is Modi ji, and this is Ambani. Okay, don't forget, this is Modi ji and this is Ambani. Okay, don't forget that. Okay, now let us listen to the conversation. So Ambani is saying, Modi ji. Okay, no, he can. Okay, understand now. Ambani is saying, Modi ji, I want to install an oil rig in the Indian territorial waters. Can you please grant me permission? So Modi ji is like, no, Modi ji. Ambani ji, yes, I will grant you the permission, but can you please submit your detailed plan on like what are the levels of extraction that you will do, or what and for how many years you will do everything. Can you submit a detailed report to me, and then our team will look into the report and then give you the approval. Then Ambani, okay, I will submit the report. Then Modi ji is like, okay, definitely you will submit the report. Modi ji is saying, definitely you will submit the report. But tell me one thing. Since you will be extracting the oil from the seabed continuously for a longer period of time, don't you think that part of the seabed will get destroyed, or will get the quality will get deteriorated? The marine life will be destroyed for that area. How can I give you approval? Then Ambani is like, Modi ji, your point is quite very good. I do understand and agree with your point. But let me assure you, at the time when I remove this oil rig from this place, I assure you that I will restore this place. And then only leave this place. Modi ji like, okay, see, if you are making a promise, then okay, I will give you approval. Now, what do you understand by this conversation? From this conversation, what do we understand? So basically, Mukesh Ambani have got the approval to install the oil rig on the condition that he will restore the place. Now please understand. Guys. Tell me, when are we installing the oil rig? We are installing the oil rig here today. We are installing the oil rig today here right now. But when we have to understand, please understand, okay? And when we are installing the oil rig, we are making a promise. What promise? Promise to restore the area. Okay, once we remove, not once, when we remove the oil rig. And now tell me, when exactly are we going to remove the oil rig? At the end of useful life. We will remove the oil rig. This is where we will remove. Come on guys, please tell me. This is where we will remove the oil rig. So now the cost to restore will be incurred here. The restoration costs will be incurred here. right? Are you understanding this part? Come on guys, please tell me, have you understood the narrative? I'm not talking about accounting treatment, that I have not explained anyway so far. I'm just saying, did you understand the storyline? Okay, so I installed the oil rig here and I made a promise to restore, and the restoration will be done when we remove the oil rig. When will we remove? At the end of the useful life. So at the end of the useful life, I will have to incur the restoration cost. Now can you please tell me, can we avoid the restoration costs? Come on, tell me guys, can we avoid the restoration costs? Come on, tell me, can we avoid restoration costs? No, you cannot. Even if you shut down the company today, even if you shut down the company today, then also you have to restore and then only you can shut down. You know, whenever you are shutting down the company, you have to take approval from multiple authorities, right? So when let's suppose if Reliance wants to shut down the business and they go to the government for approval of the closing down, they will say first of all restore this place and then you can shut down the company, meaning thereby this cost cannot be avoided. This cost cannot be avoided. Are you understanding my point? It is not, it is a unavoidable costs. Now please understand, now standard says this, tell me, with, if we, please understand, without incurring these costs, can you use the oil rig? Tell me now. If you think, okay, I will not incur this cost, can you even use the oil rig? No. To use the oil rig, you have to take the obligation of these costs. To use the oil rig, you have to take the obligation of these costs, right? So these costs enable the main asset to be operated. These costs enable the main asset to be operated. Hence, the standard says that since these costs enable this asset to be operated, hence we have to capitalize. To cost of asset. But now comes the question, how will we capitalize? Because we are capitalizing here but incurring the cost here. How exactly will we capitalize? Come on, tell me. We are capitalizing here, but we will be incurring the costs here, right? How? So standard says that for that what you have to do is, first of all, estimate these costs. Understand, these costs are an estimate. They are not actuals, they are an estimate. First of all, estimate these costs, and then since they will be incurred here and we are capitalizing here and there is a time gap, hence we will compute the present value. Hence we compute the present value and capitalize to the cost of the asset. Now understand, when we purchase the asset, we record entry as asset account debit to bank, right? Now when we incur these costs, the entry will be asset account debit. But can we write to bank? No, because we have not yet incurred these costs. Right? So it is a provision. So you will write to provision for DRRC. What is the meaning of DRRC? Decommissioning, removal or restoration costs. Okay, at present value. Come on guys, tell me, is that clear? Is this concept clear to all of you? And understand, I didn't say this, all these examples I'm not saying just for the sake of saying. They are real life examples. If you want, you can go and research. They are real life examples. Come on guys, tell me, is this concept clear to all of you? And don't take this concept lightly. This concept is of quite very strong, you can say utmost importance from an exam point of view. Okay, now whatever I'll teach, they will be important. They will be important, okay? Either from an exam point of view or from a practical application point of view, but they will be quite very important. Clear, everyone? So, okay, if it is clear, can you solve a question for me? Can you solve a question for me? Chalo, tell me. Will you solve it for me? This question. Copy, add page, paste. Da, 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 da. Chalo. There can be any multiple examples, Aditya. There can be multiple. For example, the DG generator sets. The DG, the big generator sets, which you would have seen, green color big generator sets. Okay, if you install that at your premises, that part of the premises will get completely destroyed. The cost to restore that is also a DRRC costs. Chalo, come on, guys. First of all, solve this question. Solve this question. If you have actually understood, solve this question. Yes, even coal mines can be one of those example. Not exactly, but yes, a part of the coal mines can be will suit to our example. Okay, I am giving you 5 minutes. I am giving you 5 minutes. Solve this example right now and tell me what should be the value of the asset. What should be the value of the asset on 1st April 20x4? What should be the value of the asset? Your time starts now. 5 minutes. You have to tell me the value of the asset. Quite very easy. It will take you 2 minutes to calculate the value, but I'm giving you 5 minutes. I'm a good person. It's 7:28 now, and time will wrap up. Time, this example time will up by 7:33. See, I have started receiving the answers also from Gautam, Yashika. Okay, very good, very good. I am quite super duper proud of you guys. Ding 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 ding. Wonderful, Soumya, with the journal entries as well. Very good, very good. Okay, I'm giving you 1 more minute. Just solve and then we'll discuss. Done? Shall we start discussing? I have received 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 answers. Good. Chalo. Let's discuss now. Okay. What does the question say? On 1st April 20x4, on 1st April 20x4, Vijay Limited, I am Vijay, purchased an oil rig for $1 million and incurred installation costs. Installation costs are directly attributable costs of 0.2 million Okay, now, so I in purchased here, I purchase costs is 1 million, and directly attributable costs are 0.2 million. So the cost is 1.2 million. Wonderful. Now Vijay Limited estimates a decommissioning costs of 0.6 million here to be incurred at the end of the useful life of 3 years. Useful life is 3 years. Okay. First year end, second year end, third year end. Okay. Rate of interest is 10%. Present value factor for 3 years is 0.751. So what we have to do is we have to compute the present value of it. So what is the present value? It will be 0.6 multiplied by 0.751. What is the amount? 0.6 into 0.751, that comes to 0.4506. So what is the total? Plus 1.2, which becomes 1.6506 million. Now the story doesn't end here. Point number one, what is a journal entry? Guys, please understand, at SBR level, though you might feel that okay, journal entries are not important, but journal entries are quite very important. You know why? Do you know why journal entry is important? Because for questions asked for the, you can say, pre-populated spreadsheet in question number 1, you will need the knowledge of double entries. You will need the knowledge of journal entry to rectify the draft financial statements prepared. Okay, so please understand, study anything whenever you study anything, think from the point of view of journal entry as well. Okay, if at any point I forget to give journal entry, you have to ask me. Tell me, it is your responsibility that even if I forget to give journal entry, you have to keep asking me for journal entries. Okay, now what should be journal entry? So understand, your asset is capitalized at amount of 1.6506 million. Now how much did you pay through bank? It is 1.20 million. And what is the amount that you have not paid? It's a liability, so we'll say to provision for DRRC 0.4506 million. 0.4506 million. Okay, this is what is the journal entry. Is that clear, everyone? Is that clear, everyone? Come on, guys, please tell me. Decommissioning, dismantling, removal, restoration cost. Is that clear to all of you? Come on, guys, please tell me. Come on, guys. Now, the next question that comes up here is, what should be the subsequent treatment? What should be the subsequent treatment? So subsequently, what we'll do, in my opinion, you will do three things. You will do three things. Point number one, you will depreciate the asset over its useful life, that is 3 years. Okay, now, so what is the depreciation? Per year will be 1.6506 divided by 3 years is equals to 1.6506 divided by 3 is equals to 0.5502 million per year. 0.5502 million per year. Okay, now how will the depreciation schedule look like? So it would look like this. Just a minute. Year, opening asset, depreciation, closing asset. Year 1, 2, 3, opening is 1.6506 depreciation is 0.5502, 0.5502, 0.5502. So closing asset will be 1.6506 minus 0.5502 is 1.1004. 1.1004 minus 0.5502. Okay, so 0.5502, 0.5502 nil. So this is how the asset should look like. Okay, now the story doesn't end here. The story doesn't end here. Point number one. Point number two. Point number two. Since you calculated present value, so please make a note, guys. This is something very important. Whenever in the entire SBR syllabus, or I can say in the entire ACCA syllabus, or I can say in the entire life, always remember, whenever you compute present value, you have to subsequently unwind the present value. You have to subsequently unwind the present value. Okay, now please understand, unwinding of provision for DRRC. Now, so what is the provision that you recorded here? It was 450600. 450600. I'm talking in absolute figures. Okay, this figure was in millions. This figure was in millions. 0.4506 into just 450600 is the absolute figure. Okay, now this is the amount that you have recorded. But tell me how much you have to pay. How much you have to pay? You have to pay 600,000. You have to pay 600,000. Now, can you please, first of all, okay, I will discuss the meaning of unwinding. But first of all, can you interpret this meaning? Can you interpret this 450600? It means, guys, please understand, it is very crucial and it will be applicable not only for this chapter, not only for SBR, it will not only for ACCA, it will be applicable throughout the journey. So please understand the meaning of this. No one will discuss all these small things, but it is very much required for your knowledge. Okay, please understand the meaning of it. Please understand, since the entity has an obligation to pay this amount which is unavoidable. Okay, so basically you are taking the obligation now itself. So you are saying, see, I have to pay this much. I have to pay this much at year end 3. But if I was required to pay today itself, how much will you pay? How much will you pay? If you are required to pay today itself, how much will you pay? So you will pay 450600. Let me explain it from a different perspective. Okay, see, Modi ji told Ambani, this was Ambani, right? Modi ji told Ambani, Modi ji saying, Ambani, I don't trust you. Ambani, I don't trust you. Do one thing. Okay, take a loan from the bank. Okay, or take a loan from the bank, or ask the bank to give you a commitment that at the end of third year, bank will pay this amount. Now tell me, how much loan or how much investment shall I make in the bank? How much investment shall I make in the bank? Tell me, guys, come on. What should be the obligation that you will ask from the bank? It is this amount. Why? Because if I ask for this amount, it will get unwinded, and it will become 600,000. How come? I will show it to you. I will show the exact how it moves. We calculated the present value using discount rate of 10%. So what is the finance cost for the first year, it will be 45060. So what is the provision here? It is 495660. That is this plus this is equals to this. Then what is the finance cost for this year? 10% again. So 49566. So what is the provision balance here? 49566. It is 545226. So what is the finance cost here? It is 54523, 10%. So what is the provision here? 545223. 45523. It is, on a rounding off basis, it will be 600,000. Approximately it will be 600,000. Okay, and you will have to pay 600,000. This is how it moves. This is how it moves. It is like you have taken a loan. It is like you have taken a loan. Okay, understand the arrangement. Understand the arrangement. This is Mukesh Reliance. This is Reliance. Okay, now this is Modi ji. This is Modi ji. Okay, now this is bank. Now please understand how things are moving. I'm just, see, I am not explaining now with this example. I am not explaining decommissioning. I am explaining the concept of time value of money. Please try to understand, guys. With this example, I am trying to explain the concept of time value of money, because I have seen a lot many students, not one, not two, a lot many students, they never understood. They keep on calculating the present value, but they never understand why this present value is required. They never understand. Okay, and I have promised you that I will be focusing on why always, because this why is something which will make you different from all other students. Please understand. So Modi ji is saying to Reliance, I don't trust you. I don't trust you. You do one thing. You give me 600,000 today itself. Tell me, will you do? Will you do? Modi ji is saying that I don't trust you. I don't trust you. You give me 600,000 today itself. Now tell me, if I give you an option, if you were in the place of Mukesh Ambani, and you have two options, pay 600,000 today or pay 600,000 after 3 years. Tell me, which one will you opt? If you have two options, pay 600,000 today or pay 600,000 after 3 years. Tell me, which one will you opt? So now, if I would have been in your place, I will say, definitely I will opt for option number 2, that I will pay 600,000 after 3 years. Why? Because if I have 600,000 today, I will invest it somewhere, and by the end of 3rd year, that 600,000 might become 1 million, right? It will become 1 million, and from that 1 million I will pay 600,000. Right? So basically I will not. So then Reliance is saying, Modi ji, no, this is wrong. Modi ji, this is wrong. I will not pay you 600,000 today. I have promised you that I will restore at the end of the life of the asset, and I will get it restored. Then Modi ji is saying, I agree, I understand, but I don't trust you. I don't trust you. So then Reliance is like, okay, fine. Okay, fine. Let's do one thing. I will give you a equivalent amount, that is 600,000 after 3 years, or this dash amount. Now you have to find this amount wherein you will become indifferent. That you have to pay 600,000 after 3 years, or you have to pay the amount now. what is the amount that you have to pay now that you become indifferent? That amount is called as the present value. That amount is called as present value. Are you getting my point? Are you getting my point? Okay. So I will, what I'll do is, I will pay to Modi ji. I will pay to Modi ji how much? The present value. I will pay to Modi ji the present value. Simple. Okay. So this is the concept. I believe you have understood the concept of present value. I believe you have understood the concept of present value. Is it clear, everyone? Come on, guys, tell me. Is it clear, everyone? So now these finance costs, will go where? In P and L, P and L, P and L. Okay. Now, so I believe you have understood two things. One, depreciation is clear, I believe. One depreciation part is clear. Another is unwinding of provision. And one more thing now. One more thing. Third part. At year end 3, what you will do? You will pay off $600,000. And what will be the journal entry for that? Provision for decommissioning, removal or restoration cost account debit to bank. Amount will be 600,000. Is that clear, everyone? Come on, guys, please tell me. Is that clear, everyone? Now, one more thing. Since we know that this amount is an estimated amount, okay, now it can be the case that when you are actually paying, the amount can be less or more. Since I'm writing here, since $600,000 was an estimated amount, hence actual payment can be different. It can be less than 600,000 or it can be more than 600,000. Can be different. In that case, any difference will be recognized in P and L. What will be the journal entry of unwinding? Very good, Aditya. I'll definitely write that. So journal entry for unwinding is finance costs account debit to provision for decommissioning, removal or restoration cost. Why? Because please see, this finance cost is increasing the provision. This finance cost is increasing the provision, right? So finance cost account debit to provision for DRRC. Is that clear, everyone? Come on, guys, please tell me. Now, the whole story of decommissioning, is that clear? The whole story of decommissioning, if I have to summarize, point number 1, the decommissioning cost is incurred at the end of the useful life, but we capitalize the present value of it to the cost of the asset. We capitalize the present value of it to the cost of the asset. Point number 1. Point number 2, we unwind the provision and record finance costs. These finance cost increases the provision for DRRC. Point number 3, at the end of the life of the asset, when you are actually required to pay these decommissioning costs, you will pay off these decommissioning costs. Okay, the entry will be provision for decommissioning cost, account debit to bank. But since these costs are estimated costs, hence the actual payment can be different from what we actually estimated. Okay, now in case of that difference, the difference will be recognized in P and L. Is that clear to all of you? Come on guys, please tell me. Is it clear to everyone? Is it clear to everyone till here? See, all these journal entry, no, I have already written here. Everything is written here. Okay, now I will, can I move on to the next concept? Can I move on to the next concept now? Come on guys, please tell me. Ta-da, ta-da. Guys, one thing I'll tell you. If you enjoy your studies properly, okay, then you will understand that the learning is actually a fun. Learning is actually a fun, okay, but provided you enjoy your studies. Do you see me feeling sad about studying? Oh my god, I have to teach so much. No, I'm not sad, yaar. I'm not sad. You have to enjoy your studies, okay, and just start enjoying it. Just start enjoying it and you will see the change yourself. Okay, now, so I am starting a new concept now, that is subsequent measurement, and we know that subsequent measurement can be as per the cost model or as per the revaluation model. Okay, now cost model, I believe all of you already know, the historical cost minus the depreciation gives me the carrying amount. Revaluation model also you guys already know, I believe. Okay, no, but still I will explain each and everything right now. Don't worry. Okay, revaluation model, as we have also discussed in our classes here. Please see if you can see here. Revaluation model is the cost minus the depreciation, but here we have to revalue the asset. Okay, now see here, we have to revalue the asset, but comes the question. Okay, now comes the question, how will we decide whether we have to opt for cost model or revaluation model? How to decide whether we have to opt for cost model or revaluation model? So standard says that decide on the basis of the nature of the asset, and the use of the asset. For example, a company has two buildings, factory building and official building. Now understand the purpose. Though the nature of both the properties is same, they are building, but their purpose is different. One is used for factory purpose and one is used for official purposes. Official purpose means corporate office. Okay, now let me show it to you. Factory building. See, factory building are like these. This is called as factory building. This is a factory building. Now what is an official building? Corporate office building. Corporate building. These are called as corporate buildings. Okay, corporate office. So there is a significant difference. Okay, so now basically understand. So standard says that since in the factory office you have taken it only for the production of goods or supply of services might be, okay, so that should be ideally be kept at cost. Because tell me, where will you take factory building? Will you take factory building in the within a very good area? No, you will take out in the outskirts of the city. But the official building will be in the main city. Right? The official building will be highly maintained. The value of the official building will keep on rising again and significantly. Right? So standard says that, just to give an example, just to illustrate, it does say that factory building can be kept at cost. Model. But office building can be kept at a revaluation model. Okay, so this is how we decide whether the asset is required to be kept at a cost model or might be at a revaluation model for that matter. Now comes the question, do we need to decide for each and every single asset? Do we need to decide this for each and every single asset? That okay, for this asset cost model, this asset revaluation model, this asset cost model, this asset revaluation model. No, no. This is to be done on the basis of class of assets. Now, what is the meaning of class of assets? Assets of similar nature and similar purpose are grouped in a class of assets. Do you want me to show a real example of class of assets? Do you want me to show a example of class of assets? Tell me guys, come on. I got an idea just now. I just got an idea. How will it be if I take the annual report of a listed company and while teaching something, I keep referring to those annual reports to actually show how does the accounting work? Will that help, guys? I just got the idea. Will that help? I will keep open the annual report of a listed company and I'll keep showing you. Like for example, this class of assets thing. Okay, I'll keep on showing it to you. This is how a company reports class of assets. Will that help? The annual report of a listed company. Okay, so now as of now I'm showing any company, but from tomorrow we'll be applying that idea. Okay, we'll be applying that idea. Let me show it to you. As of now, tell me which company shall I open? Let me open for that matter Reliance, because I took the example of Reliance annual report. Ta 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 da ta da ta 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 da. See here, the class of assets. The class of assets. See here. This is called as a class of asset. Land, building, plant and machinery, electrical installations, equipments, furniture, fixtures, vehicles, ships, aircrafts and helicopters. Right? This is called as class of assets. So all the land are coming up as part of this one. Now tell me, land which they are held for rental purpose, will it come here? Land held for rental purpose, will it come here? No. These land might be kept for you can say production of goods, supply of service or administrative purposes, right? These land are not for rental purpose. This building is also not for a rental purpose. This plant and machinery, if it is held for rental purpose, can it come here? Yes, it can come here. Okay, only the property held for rental can't be PPE. Others can held for rental can be PPE. PPE means property, plant, equipment. Okay, so this is called as class of assets. All the land in one, all the buildings in one, all the plant machinery in one, all the electrical installations in one, all the equipments in one. Okay, now though the company definitely has a detailed schedule of each and every single asset. Okay, now so basically what they do, the choice of cost model or revaluation model, the choice of model, that is cost model or revaluation model, okay, so apply to all the assets in the same class. How do we decide class of assets? Assets of similar nature or use are grouped into one single class of asset. Okay, now industrial building and office building, even though the nature is same, building nature is same, building, but the use is different: industrial building, office building. Hence it will be classified as separate class of assets. They will fall under separate class of assets and hence can follow different accounting model. Okay, so it can be the case that we are accounting industrial building under cost model and office building under revaluation model. Is that clear, everyone? Come on guys, please tell me, is that clear, everyone? बोले मेरे भाई, come on guys, tell me please. See, in while teaching you, sometimes I can become Salman Bhai, sometimes I can become Kapil Sharma also. Okay, sometimes I can become Kapil Sharma also, sometimes I can become any character which you want me to become. Okay, so I will be that type of faculty. I will not be a strict faculty for that matter. No, I will be a fun enjoying faculty for you guys. Okay, chalo, clear everyone? Bolo guys, clear everyone so far, everyone? Chalo, next. For asset under revaluation model, so cost model I believe is very much sorted. Okay, the next thing that comes up is a revaluation model for assets. Okay, now we are into the revaluation model aspect. Okay, we have to study if the entity has selected revaluation model. If the entity has selected revaluation model, then what has to be done for the same? Point number one, tell me, do we need to do revaluation every year at each reporting date, at each annual reporting date? Do you think we have to do the revaluation every year? No. Revaluation has to be done, guys, please understand. Generally students confuse investment property. The revaluation is done at each annual reporting date, annually. Under investment property, revaluation has to be done annually, but that is not the case. But that is not the case with, okay, that is not the case with the property, plant and equipment. Under property, plant and equipment, we have to do the revaluation only if there is a material difference. Okay, then we have to do revaluation. So basically it looks like this. Let me show you. If it is investment property at fair value model, you have to do fair valuation every reporting date. You have to do fair valuation annually. But that's not the case with PPE at revaluation model. Guys, don't worry. I will be teaching you comparative analysis also, so need not worry. I will be teaching you comparative also. Okay, now under PPE at revaluation model, what happens? Okay, we purchase the asset, we might not revalue. Year end 1 past, year end 2 past, we might not revalue. Okay, but when we feel, oh, there is a material difference, then I will come and get it revalued. Might be at year end 3 I get it revalued. Then again I feel at year end 4 also there is a material difference, so again I got it revalued at year end 4. Year end 5 again no material difference. Year end 6 I can come and get it revalued. Year end 6. So we have to get the fair valuation done or the revaluation done when there is a material difference between the carrying amount and the fair value. Otherwise no fair valuation or the revaluation has to be done. But There is a caveat here. There's a point here. Okay. Standard says that generally, but make sure that all the assets get revalued at least once in 3 to 5 years. At least once in 3 to 5 years, all your assets should get revalued. Once in 3 to 5 years, all the assets should get revalued. Okay. Now, one more point. If the fair value is significantly volatile, then the entity can consider annual revaluation also. But only if the entity the fair value experience significant volatility. Is that clear, everyone? Come on, guys, tell me, please. Clear? Okay, now comes the next concept. Treatment of revaluation gain loss. Though I have this diagram drawn, do you want me to use this or draw a new diagram? I will prefer to draw a new one. What do you say? Because if I just try to explain using this, you will not be able to retain that. But if I draw this again in the class, your retention will increase. What do you want? Tell me. Shall I draw or I just explain using this? I will prefer to draw. New one? Good one. Chalo, let's draw a new one. But first point. Forget a standard. Take up the standard like this. Throw it off. I don't want any knowledge or any rote learned knowledge. No, I don't want. Just give me the answer on the basis of logic. Okay, give me logical answer. Okay. Your father purchased a flat, 3 BHK flat, at a price of $1 million. $1 million. Okay. Now, the life of the flat is generally, let's suppose the life of the flat, okay, forget about life. You would have heard a conversation. In every middle class family, this conversation happens some or the other day. In every middle class family, this conversation happens some or the other day. Right? Like they will say, this property is valued at this much price today. If we would have purchased that property that time, this would have been the value. Tell me, have you heard a conversation like this in your family? I am coming from a Bania family. Okay, so this type of conversation are very much common in my family. In my family, it is very much common. Come on, guys, tell me, have you heard conversation like this in your family? Right? So now, basically, let's suppose. So what happened is, let's suppose my father purchased a 3 BHK for $1 million. Okay, after let's suppose 10 years. After 10 years, let's suppose the value of this property becomes 5 million. So, my father is telling to my mom, see, the property that we purchased 10 years back at $1 million is now valued at $5 million. Now tell me, will my father recognize a gain of $4 million in P&L? Will he do that? Just, I need a logical answer. Yes or no? I just need a logical answer, yes or no. Come on, guys, tell me, please. Will we recognize this gain of $4 million in P&L? No. The answer is, the answer is, the answer is no. Can you tell me why? Can you tell me why? Because the intention. Now, if you please understand, if your father is saying that this property that we purchased 10 years back at $1 million is now valued at $5 million. Just then, if you say, Papa or Dad, let's sell this property, I'm telling you, you will receive flying chappal from there. I'm telling you, I'm not lying, I'm saying it correctly. You will receive flying chappal from there. Literally, that will be the last day in your home. That will be your last day. Right? So, the intention is not to sell. The intention is not to sell. So, this gain of 4 million is unrealized. And the problem is not that it is unrealized. The problem is it will never be realized. It will never be realized. It will never be realized. That's the challenge. This is not the challenge. The challenge is it will never be realized. Can we record this gain in P&L? No, we cannot. No, we cannot. No, we cannot. So, but if the entity follows a revaluation model, they will have to show the property at 5 million. They will have to say the property at 5 million. So, let's suppose if any of the friend asks my father, what is the value of your property? Will he say 1 million? No. When it comes to telling the value of the property, he will always say 5 million, 5 million, 5 million. But when it comes to recognizing the gain in P&L, no, we cannot record the gain in P&L. No, we cannot record the gain in P&L. Okay. So when it comes to telling the value of the property, he will keep on shouting 5 million, 5 million, 5 million, 5 million, 5 million. But just then you ask, father or dad, if we are so rich, please buy me a car. Please buy me a car, or forget car, please buy me a bike. You will receive slaps. Tap, 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 tap. Then you will become, then they will say, no, we don't have that much money. Nah, we are poor. We don't have that much money. So, Are Baba, if you have gain of 4 million, then how come we are poor? So, point is, this gain is not realized and will never be realized. Are you getting my point, guys? Come on, tell me, please. Okay, and that's the reason why we record this gain or loss, not in P&L. We do not record it in P&L. No, we do not record it in P&L. Where do we record? We record it in other comprehensive income. OCI. Is that clear, everyone? Okay, now let us draw the diagram. Okay, chalo. Treatment of. I just hope my dad doesn't watch this lecture. Sometimes I have seen him opening YouTube and watching my lecture. I just hope he doesn't watch it. Otherwise, I will literally get built in my home. Chalo. Shall we start discussing? Now, The standard says that if you revalue for the first time, if you revalue for the first time and you get a revaluation gain, you will record that in other comprehensive income. And I have discussed in my basics lecture, anything which you record in other comprehensive income is, what is the treatment of it, has to be classified under two categories: recyclable or non-recyclable. So it is a non-recyclable. It is a non-recyclable. Anything which is recognized in other comprehensive income gets accumulated to an OCI reserve. From that OCI reserve, you transfer it to either P&L or to retained earnings. We'll discuss about it. Don't worry. We'll discuss in depth about it. But first of all, let me complete this point. Okay. Then you subsequently revalue again. Subsequently, if you revalue, and again you get a revaluation gain, you will record that under, again same thing, copy paste, OCI NR, not recyclable. But and subsequent, let's suppose if you get a revaluation loss, so again revaluation loss also has to be recognized in other comprehensive income. But to the extent there is a balance, there is a credit balance, to the extent there is a credit balance in revaluation reserve. What is this revaluation reserve? This revaluation reserve is nothing but the OCI reserve for this. OCI reserve. Okay, revaluation reserve. Any excess loss is recognized in P and L. Okay, now I'll take up an example. Don't worry. See here. Please see. First time you did revaluation gain of $20. Where will you record? 20. Where will you accumulate? Revaluation reserve 20. Okay. Now, year 2, again you got a revaluation gain of 30. So what will you record in OCI? 30. But where will you accumulate? Revaluation reserve. So what will be the balance of revaluation reserve? 20 plus 30, it will become 50. Then third time you again did revaluation. Okay, revaluation gain is 50. Now, so where will you record this 50? Other comprehensive income. And where will you accumulate this? Revaluation reserve. So 50 plus 50 will become 100. Now this time you got a revaluation loss. So what is the treatment of revaluation loss? See, revaluation loss also goes to OCI, but to the extent there is a credit balance in revaluation reserve. What is the credit balance in revaluation reserve? 100. What is the revaluation loss? 80. So the whole amount of revaluation loss will go to 80, will go to OCI. And what would be the balance of revaluation reserve now? 100 minus 80 is 20. Now again you got a revaluation loss of 30, but now be careful. You got a revaluation loss of 30, but revaluation reserve is only 20. Read this line again. Revaluation loss is recognized in OCI to the extent there is a credit balance in revaluation reserve. The loss is 30, but the credit balance is only 20. So what will you do? Out of this loss of 30, 20 will definitely go to other comprehensive income. What about the excess 10? What about the 10? That is excess loss. Any excess loss will be recognized in P and L. So this loss of 10 will go to P and L. This loss of 10 will go to P and L. Is that clear, everyone? And the revaluation reserve will become 0. Tell me, guys, is this treatment clear to all of you? Is this treatment clear to all of you? Now I will go for another treatment also, but before I proceed further, is this part clear to all of you? Okay, wonderful, wonderful. Now, moving further, moving further. Yes, I'm coming to that also. Don't worry. You revalued for the first time and there is a revaluation. Okay, chalo. Now, but what subsequent revaluation? Subsequent revaluation. Subsequent revaluation. So what about subsequent revaluation? So there can be a revaluation loss. There can be a revaluation gain. Now, first time when we did the revaluation, it was a loss and the loss will go to P&L. Second time when we do the revaluation, it is a loss. So this loss will also go to P and L. Now again, you got a revaluation gain. So what will happen? So standard will say revaluation gain will also go to P and L. But please understand here, the loss, now the gain that is going to P and L, the intent is not to record in P and L. The intent is to compensate for the loss recorded in P and L. So the gain which will be recorded in P and L is only to the extent loss is recognized in P and L. To the extent loss is recognized in P and L. Please understand one thing, guys, that the revaluation gain or loss, the basic treatment is OCI. But since we didn't had any balance in the revaluation reserve, we had to transfer it to P and L. We had to transfer it to P and L. Okay, but now as we get a gain, so standard is saying whatever amount you have, whatever loss you have recognized in P and L, first of all, that amount of gain should be transferred to P and L to compensate for the loss, to nullify the loss, to nullify the P and L impact. Then any excess revaluation gain will be recognized in other comprehensive income. Okay, now do you want me to take up an example for this also? Tell me, guys, come on. Do you want me to take up an example for this also? Chalo. I do have the example. See here. First time we did revaluation loss, P and L. Second time we did revaluation loss, P and L. Third time we did revaluation gain of 50. So what is the treatment of this? So first of all, tell me what is the cumulative loss recognized in P and L? 80 plus 30, 110. 110. Please understand, guys. Total loss recognized in P and L is 110. What is the gain? 50. So where will you record this gain? P and L. Now, so what is the remaining loss in P and L? 60. What is the remaining loss in P and L? 60. Okay, because we recorded a loss of 110. this is nullified by the revaluation gain of 50. So the loss in P&L is only 60 now. Now in the year 4, you get a gain of 70. So what you will do? First of all, adjust from this 60 nullified impact, done. So out of 70, 60 will go to P&L to nullify the impact of revaluation loss. Any excess, that is 10, will go to other comprehensive income, and from other comprehensive income, any amount that goes to other comprehensive income will be accumulated in a OCI reserve, which is called as revaluation reserve 10. Is that clear, everyone? Come on guys, please tell me. Is that clear, everyone? Is that clear, everyone? Now tell me, do you want me to show where does a revaluation reserve appear in SOFP? Do you want me to show where does revaluation reserve appear in SOFP? Let me show it to you. That's now the basics class comes into the picture. See the format. It is here. It's here. Other equity. In other equity comes retained earnings, revaluation surplus or revaluation reserve. Okay, come on guys, tell me, is that clear to all of you till here? The treatment of revaluation gain or revaluation loss, is that clear? The treatment of revaluation gain or loss, is that clear? Okay, if you have actually understood, can I ask you one question? Can I ask you one question? Come on guys, tell me, can I ask you one question? In the very same year, company has two assets. Asset A, asset B. Asset A gets a revaluation gain of 60. Asset B gets a revaluation loss of 40. What will be the treatment? Can you please answer this question to me? Come on guys, tell me. What will be the treatment of this? Guys, if you're watching this session, I request all of you to hit the like button right now. Hit the like button right now. Hit the like button right now. Okay. If you're enjoying this session, okay. If you're not enjoying, no need to like. But if you're enjoying, hit the like button. Very good, Disha. Very good, Yashika. Very good, Soumya. Very good, all of you. So the treatment of revaluation gain and loss is done asset by asset basis. Asset by asset basis. Even though both the assets are of same class, then also this will be recognized in OCI. This will go to P&L. What is meant by not recyclable? We'll discuss that. Okay, don't worry. As of now, I'll not discuss it, but we'll discuss. Don't worry. There is a right time for each and every concept, and each and every concept will be explained in that right time. Okay. I promise that each and every concept will be explained, but I cannot change the sequence. If I change the sequence, it will be a loss for you. No, Mansi, you are wrong. The whole amount of 60 will go to OCI. The whole amount of 40 will go to P&L. We cannot do net off. We cannot do net off. If it is the same class, different class, doesn't matter. Yes, all assets have their own revaluation reserve. Very good point, Aditya. Very good point. See, for that reason, I have written something here. Read this part. asset by asset. The treatment of an revaluation gain or loss is to be done asset by asset, asset by asset. It's asset specific. The revaluation reserve is asset specific, guys. Okay. Now, entity cannot net off revaluation gain or loss of different assets even if they belong to same class of assets. Okay. A very small point, but very good bit, very important. Okay, now revaluation gain recognized in OCI is accumulated in revaluation surplus other equity in SOFP. Is that clear, everyone? Is that clear, everyone? Come on, guys, please tell me. Now, understood? Now, let us take a break of 10 minutes and then we'll resume back and we'll study further. Okay. Today's class will continue. Today's class will continue for 1 hour more. Okay. We'll take 1 hour more class and then we'll wrap up. Okay. Let us take a break of 10 minutes and then we'll resume back. So come on, guys, we are back after the break. Shall we start? Come on, guys, tell me, shall we start? Come on, guys. Da 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 da. Shall we start, everyone? Chalo. So now I will be answering the long awaited question. Many students were asking, sir, what is recyclable? What is not recyclable? Now let me answer that. Okay. So whatever items that goes to P and that goes to other comprehensive income, please understand, guys. Whatever items, treatment of whatever items that goes to other comprehensive income, okay, from other comprehensive income, it will be accumulated in an OCI reserve. Okay, now on settlement, if there are two options, it can go to P&L, and through P&L it can go to retained earnings, or it will go directly to retained earnings. So this is called as non-recyclable. Non-recyclable means it will not go to P&L. Recyclable means it will go to P&L. Sir, now you should ask me, sir, what is the rationale behind non-recyclable and recyclable? What is the rationale behind non-recyclable and recyclable? I'll tell you, there is no rationale behind that. There is no rationale behind that. It is in the agenda of IFRS foundation also. It is in the agenda of IFRS also to remove this concept. Okay, there is no logic behind this. There is no logic behind this. Okay, so at this point of time, I will say I am saying that I will not be able to tell you the logic why it is recyclable, why it is not recyclable. There is no logic behind that. Okay, there is no logic behind that. Now, so for that, I'll say it is recyclable means it will go to P&L. From P&L, it will go to RE. Recyclable means, and non-recyclable, it will directly go to retained earnings. Is that clear, everyone? Okay, now revaluation gain is non-recyclable. It falls under here. Revaluation gain falls here. Is that clear? Okay, so what is the treatment of revaluation gain? It is recorded in OCI. From OCI, it goes to revaluation reserve. From revaluation reserve, it goes to retained earnings. Now comes the question. When? Now comes a bigger question. When? So standard says that there are two options. So entire amount of revaluation reserve will be transferred to retained earnings at derecognition of PPE. When you derecognize PPE, at that point of time, when you derecognize PPE, you transfer the revaluation reserve for that asset to retained earnings. Okay, or you transfer annually over its remaining useful life. Okay, now please understand, this option has to be selected only if question mentions to use it. If question is silent, use this approach. If question is silent, use this approach. Is that clear, everyone? Is that clear, everyone? Okay, now, do you want me to take up an example for both and discuss? Do you want me to take up an example for both and discuss? So I do have an example, don't worry. Whatever you just think of it, I have everything. See, example. VJ Limited purchased a machinery, okay, for $900,000. Tell me, guys, what do you want? I have already solved it. Okay, I've already solved it. You can refer this, whatever I've solved, you can refer it going forward. Okay, what I will do is I will solve it again for you guys, because if I solve it right now in the class, you will get a better understanding of it. Okay, now please understand. I purchased an asset for $900,000. Life is 10 years. Okay, at the end of second year, tell me what is the carrying amount of machine? At the end of second year, can you please tell me what will be the carrying amount of machine? At the end of second year, can you tell me what will be the carrying amount of the machine? Come on, guys, tell me. What will be the carrying amount of machine? Very good. 720,000. Okay. Now, what is the fair value? 960,000. So, what is the revaluation gain? What is the revaluation gain? 240,000. Where will you record this revaluation gain? Other comprehensive income. And where will you accumulate revaluation reserve? Sorted? Sorted? Now, please understand. Question goes on to state, at the end of 7th year, the machine, or forget that question, forget this part. Now, forget this part. Now, what will be the treatment of this revaluation reserve? So, as of now, we understand we have a revaluation reserve of 240,000. What is the life? 10 years. Year end 10. So now under option number A, what is option number A? Transfer at derecognition of machinery. So under option number A, what will I do? I will transfer revaluation reserve to retained earnings at year end 10. So at year end 10, I will pass journal entry revaluation reserve account debit to retained earnings. I will transfer the whole of revaluation reserve to retained earnings. Now, let's suppose if I sell the asset before year end 10, okay, then I will transfer here. I will do the entry here, revaluation reserve account debit to retained earnings. So basically, whenever I am derecognizing the asset, be it here, whenever I derecognize the asset, I will transfer the whole amount of revaluation reserve for that particular asset from revaluation reserve to retained earnings. This is option number 1. Now option number 2 is annual transfer of revaluation reserve to retained earnings. So now in this option, what I will do is I will transfer a part of the revaluation reserve to retained earnings every year. Year end 2, year end 3, year end 4, and so forth. I will do it. I'll continue doing it till year end 10. I will continue doing it till year end 10. By what amount? By what amount? So I will keep passing it. Revaluation reserve account debit to retained earnings. But comes the question, what amount? What amount? So standard says by amount of excess depreciation due to revaluation. Now, does that mean that we are transferring excess depreciation to RE? No, 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 no. Depreciation remains intact as it is in P&L. Depreciation remains intact as it is in P&L. We are just saying the amount of excess depreciation is the amount of transfer from revaluation reserve to retained earnings. So what is the amount of excess depreciation? Let me show a format, an extract of financial statements to help you understand what is the amount of excess depreciation. So what is the depreciation pre revaluation? It was 90,000. What is the depreciation post revaluation? It is 960 by 8, 120,000. 960 is the fair value, divided by life is 8 years, it is 120,000. So what is therefore excess depreciation is 30,000. Excess depreciation is 30,000. Okay, now, so what will happen is, please let me show in the extract of financial statements, how it will look like. Please see in P and L. Please see the P and L. Now, year 1, 2, 3, 4, 5 depreciation. Initially we used to record 90,000 for year first and year 2. For from year 3 onwards, I will record 120, 120, 120. This is what will go to P and L. There is no change in that. There is no change in that. So the amount that was going to P and L will continue to go to P and L as it is. The change lies in a revaluation reserve. Copy, paste. Please understand. Other equity. Revaluation reserve, retained earnings. Year first nothing, understand. Year second, we created revaluation reserve of, just a minute, let me create a space. We created a revaluation reserve of 240. We created a revaluation reserve of 240. Nothing here. But now, from now what I have to do, from third year end, I will transfer a portion of revaluation reserve to retained earnings. By what amount? 30,000. So this will become 210. This will become 30. This will become 180. This will become 60. This will become 150. This will become 90. So this will continue. This will continue forever. This will continue forever. No, in the year of revaluation, how can you transfer, Aditya? In the year of transfer, in the year of revaluation, how will you transfer? Because please understand, no, you have done the revaluation at year end too. You have done the revaluation at the end of the year, right? Transfer has to be done after revaluation. So you have done the revaluation at year end. If you would have done the revaluation at the beginning of the year, yes, I will transfer in the year of revaluation also. Please understand, Aditya, okay? If we would have done the revaluation at the beginning of the year, we would have transferred in the year of revaluation also, okay? Doesn't matter what is the year of revaluation. What matters is we transfer revaluation reserve to retained earnings over the remaining life. Remaining life starts from the date next to revaluation date. Getting my point? Getting my point, Aditya? Are you getting my point? Okay. So this is the concept of revaluation reserve. See here. Option number, transfer of revaluation reserve. Treatment of revaluation surplus. Transfer revaluation reserve to retained earnings. Option A, when question is silent, use this. Transfer revaluation reserve to retained earnings at the time of derecognition of the asset. It involves retirement or disposal of the asset. Now, only if the question specifically mentions transfer revaluation reserve to retained earnings annually as the asset is being used by the entity. Amount of transfer is excess depreciation due to revaluation, that is depreciation post revaluation minus pre revaluation. No impact on P&L. Okay, P&L will continue to record depreciation as it is. Okay, depreciation will continue in the P&L as it is. No impact on P&L. I believe it is very much clear. Now I request all of you to solve this question. We have given one more point here. We have included one more point here, this point, okay, which can be easily solved. So I give you this point as an assignment. Okay, it's an assignment for you guys to solve this example. It's an assignment. Okay, now I want to move on to the next topic, a quite very easy topic, but and not also not that important from an exam perspective, not that important from an exam perspective, or not that important from a practical life perspective also, for that matter. Okay, since it is in our syllabus, we have to study, so I'm teaching it off. Okay, now revaluation approach. Option A, depreciation elimination approach. What is the meaning of depreciation elimination approach? Please understand, guys. So I'm explaining how basically I am discussing now revaluation approach. How do you pass journal entry for revaluation approach? Okay, so let me take an example and explain both the situation. So let's suppose the cost of the asset is 100,000 and accumulated depreciation is 55,000. Okay, now so there are two methods. Method number one is depreciation elimination method. So under this method, what you do is you first of all eliminate this accumulated depreciation with the cost of the asset. Basically, you adjust this accumulated depreciation to the cost of the asset, thereby reducing the cost itself. So what is the entry for that? Accumulated depreciation account debit to asset. You reduce the cost of the asset by 55,000. That is the amount of accumulated depreciation. So now tell me, what is the cost? What is the cost of asset now? 100,000 minus 55,000 is 45,000. Now what is the fair value of asset? What is the fair value of asset? Fair value is 65,000. Fair value is 65,000. So what is the revaluation gain? 20,000. 20,000 is a revaluation gain. So how do you record this revaluation gain? It will be asset account debit to other comprehensive income 20,000. So what happened here is, first of all, you reduce the cost of the asset, okay, and then revalue the asset. Clear, everyone? See, that's what I have written here also. First of all, you eliminate the accumulated depreciation against the gross cost of the asset, and then increase or decrease the net carrying amount to its fair value. Clear? Now, the second approach is a restatement approach. The second approach is a restatement approach. Now, what happens in restatement approach? What happens under restatement approach? Please understand. Now, under restatement approach, let's suppose your cost is 100,000. Your accumulated depreciation is 55,000. Thereby, your carrying amount is 45,000. Okay. Now, your fair value is 65,000. So, what is the increase? So you have to restate, you have to calculate what is the percentage of fair value as a percentage of carrying amount. So what is the percentage? Tell me. 65,000 divided by 45,000, that is 144%. 144%. So fair value is 144% of the carrying amount of the asset. So now accordingly you have to compute the carrying amount cost. You have to increase the cost by you have to restate the accumulated depreciation, restate cost and accumulated depreciation to 144%. So it will be 144,444. It will be 74,444. Just let me check the figures are correct or not. 79,444, not 74,444, 79,444. So what is the increase of the cost? So your cost increased by 44,444. Your accumulated depreciation increased by 24,444. So what is the journal entry? Your journal entry will be asset account debit 44,444 to accumulated depreciation account will increase by 24,444, and hence what is the net amount? 20,000. So this is the net increase in the asset which will be recorded in other comprehensive income. So the net impact is the same, that is going to other comprehensive income. The net impact is same, 20,000. Whichever approach you take, the net impact is the same. But what changes is the journal entry which you are passing. I believe it is very much clear to all of you. Come on guys, please tell me. Is that clear to all of you? Come on guys. So this is what changed here. This is what changed. Is that clear, everyone? Come on guys, please confirm. Paka clear, everyone? Okay, chalo, done. So with this we complete the re-evaluation model of the asset, and now we are coming on to now we are left with very small topics. Do you want to continue today or tomorrow? I think we are left with very small topics: depreciation, modes of acquisition, and then some special cases, and then we are done with the chapter. So let us take it up rather than today. We'll take it up tomorrow itself, because we have tomorrow's day to complete this chapter. Okay, and we will complete and we'll wrap up this chapter of property, plant, and equipment tomorrow. I believe you guys are enjoying this session. Okay, whatever feedback do you have, I request all of you to drop your feedback in the comment box of this video. Thank you all of you. Bye bye. Okay.